The financial instruments are a very complex topic, and therefore there are in fact 3 standards dealing with them. The most famous is probably IFRS 9, and then there is IFRS 7. You can find the summaries of both of them on my channel. IAS 32 is the oldest one of these 3, but it really sets the basics. Let's take a look. I am Sylvia of IFRSbox.com, and I help you understand IFRS. I have created the IFRS Kit, my premium course full of videos, Excel files, examples, and other useful materials. So check that out at IFRS Box if you need to. The standard IAS 32 was first time issued back in 1991, but then it was revised significantly at 2003 and applies from 2005 in more or less current form with some amendments. The objective of IAS 32 is to establish principles for presenting financial instruments. So basically, it provides definitions of financial instruments, prescribes the rules for classification of equity versus financial liability, and also describes the compound financial instruments. It also provides the rules for accounting for Treasury shares and offsetting, just to mention few major items. So IAS 32 does not tell you how to account for financial instruments, how to measure them, how to apply hedge accounting and other topics, because they are covered in either IFRS 9 or in IFRS 7. So what is a financial instrument? It is any contract that gives rise to both financial asset of one entity and financial liability or an equity instrument of another entity. So there is always some sort of contract. Financial instrument is a contract between two parties, and this agreement has some clear economic consequences, and also the parties to it cannot avoid a contract. An entity could be practically anybody, individual, partnership, incorporated body, or government agency. It really doesn't matter. Financial asset is any asset that is a cash, simple as that. Financial asset is also an equity instrument of another entity, for example, shares issued by another entity, not own shares. Then it could be a contractual right to receive cash or another financial asset from another entity, and the examples are trade receivables or loans receivable, bonds acquired from another entity, and similar. And a financial asset is also a contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. For example, purchased call options. It is an option to buy, for example, some assets at some future date at fixed price, but only when it is more favorable to exercise it than not to exercise it and buy at the current market price. Purchased put options, another example, it is similar as call option, but here it is an option to sell, not buy. The last group of financial assets in the definition represents some contracts that will or may be settled in the entity's own equity instruments and is either a non-derivative for which the entity is or may be obliged to receive variable number of entities' own equity instruments, or a derivative that will or may be settled other than by exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. I know this sounds a bit alien, but we will explain this a bit later in this video. Financial liability is a contractual obligation to deliver cash or another financial asset to another entity, and examples of such financial liabilities are trade payables or loans payable or similar instruments. Financial liability is also a contractual obligation to exchange financial instruments with another entity under conditions that are potentially unfavorable. Examples are written call options, and basically it represents the obligation, well, if option is exercised, to sell specific item at a specified days, but not the own equity instrument. And that's not liability then, it relates to some other instruments. Written put option, another example. It's similar as call option, but here the obligation is to purchase, not to sell. Apart from that, a financial liability is also a contract that will or may be settled in the entity's own equity instruments. And again, we are talking about the transactions in own equity, like a non-derivative for which the entity is or may be obliged to deliver variable number of the entity's own equity instruments, or a derivative that will or may be settled other than by exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. And again, we will take a look at these transactions in own equity later. Then we have equity instruments, and this is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. And the important thing here is the residual interest. So if we take assets of some company and deduct all of its liabilities, the result is the equity, and therefore the equity is sometimes called net assets. So if you acquire or issue a financial instrument, then you need to classify it on initial recognition as either a financial liability, financial asset, or an equity instrument in accordance with the substance of the contractual arrangements and the definitions. Legal form is not always the same as the substance. For example, you can have preference shares that are called shares, but in fact they are a liability based on the definitions. It's not a problem to classify an asset as a financial asset, but sometimes it is challenging to distinguish between equity and liabilities. And in this case, we need to ask, is there a contractual obligation to transfer the economic benefit, cash or another financial asset, to the other party, or even own equity instruments? If yes, then the instrument is classified as a liability. For example, preference shares are some sort of liability if they are mandatorily redeemable after some years, and you must pay dividend on them based on some interest. If there is no such an obligation, then the financial instrument is classified as equity. For example, ordinary shares. Here you don't have an obligation to pay anything. Let's come back to transactions in own equity. We defined the financial assets and liabilities earlier in this video, and we spoke about the transactions in own equity too. Everything else that does not meet those definitions is equity instrument, because it is a residual that remains when you deduct the total liabilities from total assets. So based on the definitions of other financial instruments, the equity instrument is either the contract that will be settled by the entity receiving or delivering a fixed number of its own shares for no future consideration, or exchanging a fixed number of its own shares for a fixed amount of cash or other financial assets. And very important thing here is own shares and fixed amount. So what's the difference? If your company writes or sells an option to deliver 100 shares of some other company, then it is not an equity instrument because company does not sell its own shares. It is a liability. If a company writes an option to deliver own shares for amount of 100 currency units, that's also not an equity instrument. That's the liability because the number of shares is a variable and it depends on their market price or other contractual provisions. But if your company writes an option to deliver 100 of own shares, here we go, that's equity instruments. Shares are yours and their amount is fixed. So I hope that you get the point here, and if you'd like to learn more about equity instruments and their accounting, you're very welcome to check my IFRS kit. Sometimes you can have a financial instrument that is a mix or so-called compound financial instrument. And what is it? It is a financial instrument that contains both a liability and equity element. Typical example is a convertible bond where issuer or borrower issues a bond to the holder or lender, and the lender has an option to get the bond repaid by ordinary shares of issuer instead of getting paid in cash. Here there are two elements. A liability element is a conventional loan or bond because the issuer has a liability to settle it with a transfer of some cash or a financial asset. And the equity instrument here is a call option written to the holder to convert the debt into a fixed number of issuer's common shares. And in this case, IAS 32 requires to classify and present these two elements separately. So the loan element is shown as a liability and the equity element as equity. There are more methods to do it. For example, residual method or with or without method is applied frequently. So if you're interested, please check out my IFRS kit for detailed examples and calculations. IAS 32 then sets rules for Treasury shares that are own shares of an entity. And in practice, it could also be some other own equity instrument, but in most cases, shares. If an entity acquires Treasury shares or buys own shares back, these shares can never be presented as a financial asset. Instead, acquisition of Treasury shares is directly deducted from equity. The next big topic of IAS 32 is offsetting a financial asset and a financial liability. It is presenting a financial liability and a financial asset as one single net amount in the statement of financial position. A very common situation of offsetting is when one company sells goods to another company. In this case, the first company has a receivable to the second company, and vice versa, the second company has a payable to the first company. And let's say that the second company is in fact some retail chain and bills listing fees or promotion fees or fees for other services to the first company. So in this case, the first company has a payable to the second company for the listing fees, and the second company has a receivable to the first company. So what to do in this situation? Can the first company net off or offset the receivable and payable to the same party, the second company, and present it as one single receivable or payable? And can the second company do the same? Yes, they can do if both of the following conditions are fulfilled. The entity must have a legally enforceable right to do it. So there must be some legal right, contract, or some agreement about the netting, right? And the entity intends to settle on the net basis or to realize the asset and settle the liability simultaneously. If both conditions are fulfilled, then the entity must offset these assets and liabilities. So it's not a choice, it's a must. IAS 32 then arranges a few more areas like putable instruments, contingent settlement provisions, presenting interest and dividends, and some other areas. So if you're interested and want to learn more, you're very welcome to check IFRSbox.com, subscribe to my newsletter, and maybe consider the IFRS kit that will teach you all these concepts and much more in great details with loads of practical examples. Bye-bye, and thanks for watching.